Welcome everybody to today's tax strategy and planning for returning to the UK event. My name is David Kelly. I'm the Executive Director of the British Chamber of Commerce here in Singapore. A very warm welcome to you all. For those considering an eventual or imminent return to the UK, it is important to understand the key considerations for a tax efficient move, as well as the social implications of settling back in the UK after being away for a period of time. After enjoying low income tax on Singapore earnings, no tax on investment income and no national insurance deductions, moving back to a high tax jurisdiction such as the UK can often end up being a shock and a huge setback. Today we will learn a little bit around some of the care and the planning that you can put in place. The UK can actually be a surprisingly tax efficient place for you, but also some of the social implications as well of moving back and what that looks like. So I'm delighted to introduce our speakers today, Martin Rimmer, Head of Tax at Select Investors here in Singapore, and also Nigel Preston, former CEO of St James's Place in Singapore, who's based in the UK and will share some of his stories around moving back to the UK as well. As valued members of the British Chamber, Select Investors are also our event partners for this afternoon's webinar, so a huge thank you to them for your support. Thank you, Martin, and to the team. Please do post your questions in the Q&A box on the Zoom toolbar. You can like questions posed by others so that the most popular ones rise to the top, and we'll be asking those in the Q&A session at the end. You can ask questions anonymously if you're worried about asking questions in an open forum as well. So before I hand over to Martin to start the session, I'd just like to run a quick poll looking at when you're planning to move back to the UK. So Helen, if we can just quickly bring that up for everybody now. There we go, and we'll just give that a couple of seconds just to give you all a chance to put your feedback in, and this will help Martin in terms of some of his comments that he will be addressing to you all this afternoon. Great stuff. So without further ado, I'm going to hand straight over to Martin. Martin, a very warm welcome to you. Thank you again so much for your time. I'm very much looking forward to the session.
Thank you very much indeed, David, and it's a great pleasure on behalf of everyone at Select Investors indeed to be hosting this webinar today. Let me start by sharing my screen so we can get going straight away. And I think just before we get going, just a couple of words. Needless to say, I need to provide some form of a disclaimer for the work that we're doing today. And there it is. I won't read it to you, but as you might expect, you know, we have to give you some kind of a disclaimer. Everything you're about to hear is obviously correct and it's accurate based on the law as it sounds today. But the information is, of course, general in nature, and we don't really want you to take that as a recommendation for action. Really, the art involved in providing any kind of professional advice, whether that's investment advice, tax advice, or succession advice, is in applying the law to your specific circumstances. And as we do that, recommendations and strategies are developed which are personal to you and take account of the nuances of your particular and personal circumstances. It's very easy to go online and Google, of course, and hmrc.gov.uk is an amazingly good resource for information. But what we do is we take our extensive knowledge and years of experience and apply that to you in a really personal way to generate outcomes that matter and make a bit of a difference to your lives. So I'd encourage you very much to engage with us individually, and we'll work with you to turn the general principles you're going to be hearing about now into some specific value-laden outcomes which meet your personal objectives. So my name is Martin Rimmer. I'm Head of Tax at Select Investors, and I'm delighted to be joined by my very good friend Nigel Preston, who used to run St James's Place in Singapore. And Nigel, we should pity him because he's based in the UK at the moment, where they have lockdown, where it's 8 AM in the morning and it's cold. So thank you, Nigel, particularly for making the effort to come and join us today. So this talk really splits into two parts. The first and the major part, if you like, is just running through some of the key UK tax principles involved in planning for a move back to the UK, and I'll split it into six slides, or six sections, and there are 17 slides. Bottom left of the bar here, you can see the slide numbers, and therefore you can see how far we have to go. But I just want to spend just a few minutes talking about key principles, what we can control, what we can't control, some of the tax rates and allowances. I'll talk briefly about the taxation of employment earnings that you might continue to receive after you've gone back to the UK. I'll then move on to cover 4 lowest common denominator pieces of UK tax planning advice. So things that apply to everybody, whoever you are. These are good principles that will apply. We'll just spend a very brief slide thinking about how and when you become UK resident. And then we'll talk about the 2 main asset classes that we're all most passionate about. So firstly, capital gains on property, and then we'll talk about how to make your money and your assets work for you in a truly tax efficient manner. There'll then be another poll question, and then I'll be introducing Nigel to share his thoughts on what it's really like moving back from the other side. So I wanted to introduce you first of all to a few words that I have at the end of every email that I send to clients. I'll let you read it, but in essence, why is it that we do what we do when we talk about people's money and their tax planning? Well, obviously, as a UK tax practitioner, my job is to help to keep people safe from HM Revenue and Customs and to save them as much tax as possible, and that's all very helpful. Why do we do that? Well, it's in order to create financial efficiency, to help to grow your wealth. Well, why do we do that? Well, we do all of that so that you can realize your ambitions and do what with your lives those things that you really want to do, effectively to lead happier lives on the basis of financial security. So that's really the thing that drives me and drives everyone in the team, is that we're here to make a difference to your lives, and we do that by helping you save tax and creating financial security. So straight into the main body of the presentation, key planning principles. As David rightly said, as we move from this low tax jurisdiction called Singapore to the UK, it's obviously a high tax jurisdiction. The highest rate of UK income tax is a tiny bit more than twice the highest rate of Singapore income tax. And unlike Singapore, the UK taxes investment income and gains. We have inheritance tax. We have national insurance as well. So, you know, it does need to be planned for. Like anything in life, like any transition, it's something that can be managed effectively if we take the time to get that right and to plan effectively for it. Now, obviously, it's important to understand how and when you become resident. With that piece of knowledge, we then have a window of tax planning opportunity ahead of us that allows us to recommend changes and restructuring. And there's a lot that you can do in the run up to the move back to the UK that makes a meaningful difference from a tax perspective after you are a resident in the UK. Now, my comments today are really focused primarily on those who are going back to the UK, either because they are from the UK originally, or perhaps because you intend to settle there permanently. When you do that, when you become a UK resident, you become subject to tax on worldwide income and gains, and that's really the principle I'll be talking about today. But I just wanted to just mention that if you're moving to the UK and you are not of British descent, there are a whole range of additional tax planning opportunities open to you that are not open to someone like me if I went back. So if you're not of British descent, you have the opportunity of sheltering non-UK incomes and gains from tax by under what's known as the remittance basis, and you can also shelter non-UK assets from inheritance tax. Now, that requires separate bespoke planning, but I just want you to understand that there are bigger and better things we can talk about if you're in that non-British category. But of course, when we're thinking about a move back to the UK, there's a whole load of discretion you have whether or not to go at all. I talk to a lot of people who want to maximise the amount of time they spend in the UK, but without becoming resident, and that's actually a fairly straightforward piece of work to do. Whether the outcome is sufficient enough for clients is a different question, but you know, there is that. Let's just ask that question. You think you've got to go back to the UK, but do you really have to go there? So, you know, we can also influence how and when you become resident. You have a lot of control over when tax residence starts. And we'll be talking about that a little bit when we come to the section on split year treatments. You also have control about what to do with your assets, who owns them, how are they held? Tax efficiency is typically driven not by what you choose to buy and invest in, but more about how you hold it. So we can think about structuring for tax purposes. Obviously, you have a choice about when you do your planning, and you have a choice about whether to do it sooner rather than later. And of course, I would recommend that everyone has a firm idea of what their options are, even if the move back to the UK may not be material now. So key planning principles. I also just wanted to introduce you to the main rates of tax in the UK, which are these. So we have a basic rate of tax. So the first £37,500 is at the basic rate, and the basic rates depend on the type of incomes and gains you've got. So we have all incomes on the left-hand side. We have dividend income, so dividends from shares and unit funds, and then we have capital gains from the sale of residential property and everything else. Then we have a higher rate of tax, so between £37,500 and £150,000, and again you can see that those increase quite considerably, and then an additional higher rate, which is of course a bit of a nightmare. What's in red is the worst in class. If we have discretion over how to generate income, we do not want to be generating income that is not dividend income. Green in class is the best. So we want dividend income, and we want to generate capital gains, and that's going to be a feature of what I talk about a little later on. Just to illustrate the power of that to you, let's assume that you have £200,000 of what we call other incomes. So that would generate an income tax liability of £75,000, so an effective rate of 37.5%. If all you had was £200,000 of dividends, okay, that would drop a little bit to 58,000. If all you had was gains from the sale of residential property, again you can see the number there, and then finally gains from the sale of other assets like shares and units and funds. Huge disparity. So what you have and the type of income and gains you generate in the UK is important, and that's a key feature of our planning. So next couple of slides, I just wanted to talk about employment earnings. It's very normal for people when they leave Singapore and move to the UK. They'll either do so in employment or outside of employment, but in many cases, clients will often have share vesting rights or long-term incentive plans, bonuses that tranche out over a period, and that period extends into a period of UK resident status, even when they have stopped working. It's also quite common for people, if they're leaving, they're basically perhaps being retrenched, to receive some kind of termination settlement as well. And it's going to be very, very important to understand the nature of how that's been put together, so that we can ensure that you don't accidentally fall into UK tax. Just on termination payments, the difference between being resident and non-resident is often taxed at the highest rate if you're resident. If you receive your termination payment, the whole lot is taxable at your highest rate, whereas if you're non-resident, you can enjoy a full or partial exemption. So knowing when you get that settlement is absolutely key. But I just wanted to talk very briefly about bonuses and incentive plans. So if you go back to the UK, you've had your career here, and you're continuing to get payouts from the company, whether that's in the form of shares or just money that you receive. This comes up very, very often. So here are our UK tax years, 6th of April to the 6th of April. And here we have a point at which you become resident for tax purposes in the UK. And here we have a performance period for your earnings. So you go back to the UK, perhaps you're continuing to work, you're sent back, and there's a calendar year period over which a bonus has been earned. It's paid later, paid after you come back to the UK, but it relates in part to your time in Singapore. And the basic tax principle is that the part of that relates on a pro rata basis to the non-UK resident period of service is exempt, and the balance is taxable. So when it all gets paid out in the UK, we have to put it all on your tax return, and just part of it is taxed. If you leave Singapore and stop work, then it's all put on your tax return, but none of it is taxed. Now, earnings and compensation schemes are very, very varied, of course, and we need to look at each one to be sure that we've got the right tax treatment. But the principle is the UK doesn't want to tax what you did abroad, and that's really the main takeaway from that section. But we do want to talk to you about the vesting of share rights and bonuses ahead of a move to the UK. So that's employment. And now what I wanted to do is just focus on 4 lowest common denominator pieces of UK tax planning advice if you're moving back to the UK. And these should apply to everybody. So hopefully these will all resonate with you. The first thing I would say is to understand what the UK tax treatment of all of your existing assets will be. So we've got a bunch of standard assets: property, shares, cash accounts. It doesn't matter where they are in the world, the UK tax treatment is the same, whether they're in Singapore, somewhere else, or in the UK. But we have to think about certain non-UK assets which would carry slightly different tax treatments. And the first one I just wanted to focus on was holdings in non-UK unit funds, so mutual funds and the like, and that are situated outside of the UK. And there's actually 2 types. There's what we have, what is known as reporting funds. So these are funds where the manager has applied to HM Revenue and Customs for a certain status, qualifying status. If you're a resident in the UK and you sell your units in those reporting funds, then you pay capital gains tax on your profits, and if you make a loss, that loss can be set off against any other gain. Beautiful, that's exactly what we want. But if the fund manager has not done this, they are non-reporting funds. When you come to sell them in the UK, the gain is actually subject to income tax, and the difference, the highest rate of capital gains tax is 20. The highest rate of income tax is 45. So it's really very important to identify the nature of directly held unit funds. And I can do that for you. There's an HMRC database that we can go and check, but it's really important to understand that one. Offshore managed portfolios, so private banking portfolios, or really any kind of portfolio managed by someone outside of the UK, which consists of direct equities and things like that. I mean, they're perfectly okay. There's nothing wrong with them. It's just these offshore entities will not provide you with UK tax year-end reporting. So that makes the task of completing the tax return quite difficult. Maybe not your problem if you ask me to do it, but the point is you don't get all of that tax support that you would get if it was an onshore managed portfolio in the UK. Life assurance wrapper is an extremely common vehicle to hold investments here in Singapore. So let me give you a few names of companies. So Aviva, Generali, Quilter, Old Mutual, so on and so, Friends Provident International, and indeed St James's Place. If you hold assets with any of those companies, they are more likely than not to be life assurance wrappers. So holding vehicles for shares and units and funds. And these come in two types. So we have what we call non-personalized. A non-personalized life assurance bond is simply something that holds units and funds or cash, and it's got a fantastic UK tax treatment. You don't need to do anything. Just keep it. Just keep it. It's a great vehicle. But if they're non-personalized, in other words, if they hold shares in individual companies or individual corporate bonds or private equity investments and outlandish things like that, then they have an absolutely appalling tax treatment in the UK. And we just need to identify what you have, because it's very simple to change from being personalized to non-personalized, but it is an action step, and that does require identification. Then finally, CPF. If you go back to the UK, you've got rights in CPF. You hand back your permanent resident card, then you will get your CPF paid out to you whilst you are UK resident. In short, the UK taxes just the part of your CPF that corresponds to employer contributions and return on investment from the 6th of April 2017. That requires a little unpicking, but in essence, understanding what you've got is absolutely key. Second lowest common denominator piece of tax planning advice: take gains before you become a UK resident. Provided you be non-resident for 5 tax years, 5 UK tax years, that is the right thing to do. You would be exempt from capital gains tax whilst you're non-UK resident, and you are exempt from UK residential property gains made whilst non-resident as they accrued up to the 6th of April 2015. So taking gains, making the gains, selling the assets, giving them away whilst you're non-resident is often the right thing to do. But let's not forget the importance. Actually, one other thing before I get onto that, yes, if you have assets that are at a loss, don't do anything with them. Don't sell them before you go back to the UK. Wait until you've gone back to the UK, because then you have a loss which is within the capital gains tax regime, and those losses can then be set against future gains. So keep your loss makers. We don't want anyone to make a loss, but if you do make a loss and you crystallize that loss, just make sure you do that as a UK resident. And the point I was then going to go on to make, our fourth point, is let's not neglect the fact that we often buy assets in currencies outside of pounds sterling. Best illustrated with an example. So Bill bought $250,000 of shares in Singtel when it was 2.5 to the pound. I'm sure we all remember those wonderful days. So obviously $250,000 purchased. They're worth $325,000 when he sells them. At that point, the exchange rate is 1.75. So that's clearly 325,000. There is a gain of 75,000 Singapore dollars. But if we flip that into sterling, it's £100,000 cost. It's £185,000 of proceeds because of the change in the exchange rate, and an £85,000 gain. Okay, it's a bit of a contrived example, but it's just there to illustrate the point. And what looks like it might be a Singapore dollar loss, in this case, if he sells them at £225,000 at the same exchange rate, might still be a pound sterling gain. So analysing what you've got and taking a view on any latent gains and choosing to do things with those gains ahead of your relocation to the UK is important. So general tax planning techniques. Now, just one slide on how and when you become a UK resident. I've called it the dark art of split year treatment. Split year treatment is the technical term. It's a dark art simply because the government has chosen to make something that is actually intuitive and simple. They've chosen to make it very convoluted. So it's one of those limited areas of tax where I think it's too hard to go and research it yourself. Come and talk to us. It's just, don't waste the time. I can just give you the right answer rather than you spending hours trying to understand the law. So as we know, the UK tax year runs from the 6th of April to the 5th of April, and the default position is if you test positive for UK resident status in that tax year, then you are resident for the whole of the tax year. That's the default position. But as the name suggests, split year treatment allows us, if certain conditions are met, to split the tax year in which you become resident into a non-resident bit where we can do tax planning and a resident bit where you're taxed on worldwide income and gains. So identifying whether that treatment will apply and when it applies from is going to be absolutely key. So the question I hear you ask is, well, how do we trigger resident status in the UK? And you've got to meet one of these 4 conditions. So either you hit 183 midnights in the UK in the tax year, or you start to have your only home in the world in the UK at some point in the tax year, or you start to embark upon a qualifying period of full-time employment in the UK, or you simply breach limitations under what we call the sufficient ties test. Now that bears for further explanation, but time doesn't permit me to do that. But suffice to say, we need to understand how you become resident. Which of those boxes are you going to tick? If you tick one of them, you'll be resident for the tax year. But we then need to decide whether split year treatment applies, and there are 5 ways in which that can apply. Weirdly, they call them case 4 to case 8. The ones that typically apply to most people are case 4, 5, So starting to have your only home in the world in the UK, starting full-time work in the UK, or there comes a point in the tax year in which you become resident that you begin to have a home in the UK, even if you continue to have one abroad. And the point I want to make about all of this is that three sets of conditions need to be met. First of all, there's a set of conditions that pertain to the non-resident part of the tax year. There's another set of conditions that pertain to the resident part of the tax year. And then finally, in certain circumstances, there are some conditions that pertain to the following tax year. Now, that all sounds very complicated. And as I said, the way they've drafted the law is not helpful to us. However, what I would say to you is that I can only think of 2 or 3 cases in the 7 years that we've had this particular part of the law where someone who wanted split year treatment couldn't get it. So they've not written the rules in a way to catch you out, but it does need to be navigated. Now, I want to be sitting down with you in the tax year before you become resident to make sure we understand together what are the conditions that you need to meet in the run up to that point at which you become UK residents. So very, very important, because once we've identified that point, we have our tax planning window of opportunity. We know how long we've got to act. And as I said before, there's a lot that can be done. So just coming then into the closing 2 parts of my my talk today, just a couple of things about capital gains tax on property. Whilst Select Investors and St James's Place is an award-winning firm that provides investment advice, we're very conscious and very, very happy with the fact that most of our clients are really, really keen on property. Property's been a spectacular asset class over a long period. We'd be foolish to deny that. And of course, we encourage people to have balanced portfolios, including property. But of course, with that, you have a fixed asset in the UK, and obviously you can't pick it up and move it very easily. So the government knows that. So it applies really quite a draconian suite of taxes to property, and one of them is property gains. And the problem in essence we have is this: is when you become UK resident, it doesn't matter that the majority of a gain might have accumulated whilst you're a non-UK resident. If you crystallise that gain as a resident, the entire thing is taxable. In other words, there's no relief for the fact that the accumulation happened whilst you're a non-resident. That's why we tell people to sell shares and to sell units and funds whilst they're not UK resident. But of course, it's very difficult to make those gains without selling the property or giving it away. That's the issue. Sometimes we can't get rid of properties, sometimes we don't want to get rid of properties, but we know we've got latent gains there. And really what I want to do is give you 3 examples that illustrate the problem. The solutions to the problem in each case typically will be one of these things: either selling whilst you're non-UK resident, that's often the most tax efficient thing to do, or if you don't want to sell and can afford to do it, to give the asset away. So perhaps as part of a structured and controlled approach to the succession of your assets down the generations. Gifting, if it's going to be done, is best done whilst non-resident. Capital gains tax can only apply when you sell or give. You could choose to do neither of those things and simply hold the asset until you die. If you do that, at that point, no capital gains tax, which is great. If you do make gains, there are investment options in the UK that allow you to defray the cost of that in tax terms. So making investments into what we call the Enterprise Initiative Scheme, the Venture Capital Trust Scheme, or the Seed Enterprise Investment Scheme. And there are other techniques that we can use, such as pension contributions or gifting into UK registered charities to increase the amount of the gain that's taxed at lower rates. So, but in terms of the examples, let me, this all fits onto one page, so we'll be able to motor through this fairly quickly. So, former main home in the UK, which is rented in Singapore and then reoccupied. An investment property purchased whilst in Singapore that is then occupied as a main home, and then a main home in Singapore, which is then rented after someone goes back to the UK. And I do this just to illustrate the nature of the issue. And why do I do that? Simply so that I can impress upon you the importance of understanding the quantum of any latent gains, because that information can help you make decisions. So illustrate a couple of examples with Paul and Charlotte. So they bought a house for £250,000 on the 1st of August 2018. They moved back to the they live in Singapore for 4 years. I haven't put that in there. They live in Singapore until 2012. Then they go. So they moved to Singapore in 2012. Then they rent the property out, then they move back to the UK on the 1st of August 2021. So they've had 9 years away, and they live in it again as their main home for 3 years before selling it for £675,000. So that's the basic fact pattern. They're resident when they sell in all cases, so non-resident capital gains tax doesn't apply. You will have heard if you sell a property as a non-resident, the value at the 6th of April 15 is important. That's irrelevant in this situation. We have to report the transaction and pay tax on it if it's due within 30 days of completion. So 2 examples: main home, lived in it for 4 years, rented it out for 9, reoccupied for 3 years. We've got the numbers. Total gain, 425,000. They get relief for the fact they lived in it, but there's still a taxable gain of £134,000 there. And I've assumed a tax rate of 28%. It may not all be at 28%, but you can see that's a fairly hefty tax bill, even for selling a property that was the main home and became the main home again. The second example is occupation for the last 3 years only. In other words, they buy it in Singapore. They were non-resident when they bought it, has been rented out all the time except for the last 3 years when they live in it. They only get relief for the last 3 years of occupation. So, of course, the taxable part is very much higher. The final one is their home in Singapore, which they buy on 1st of August 2008 for $2.5 million when it was 2.5 to the pound. Moved back to the UK 13 years later and then rent that property out for 3 years when it's sold for 4.75 million Singapore dollars when the exchange rate is 1.75 to the pound. So a load of relief for the fact it was the main home, but still there's a reasonably healthy chunk of taxable gain there, which attracts tax. So all of that has been said just to make the point that it's easy to assume that properties you live in are exempt. It's not always the case. So a good time ahead of the move back to the UK, let's just run the numbers on different scenarios as to what capital gains might be as a non-resident or as a resident under different scenarios, just to give you information that may help in decision making that you have to do. And then the final part of my part of the talk today is investment planning for tax efficient outcomes. So now we're talking about non-property assets, so money you have in the bank, shares, investments, so on and so forth. And really, this is what St James's Place does. We manage money. So I think the first point I want to make as a tax guy is that we want to use all of the allowances that the UK government gives you. We don't want to push the envelope on our planning. We don't want to be contentious. We want to be very, very mainstream, and it starts by doing the simplest things first, which is your tax allowances. So you have a personal allowance, £12,500 tax-free. You can also have another on top of that, £2,000 of dividends from shares and units and funds, tax-free. You can also have up to £1,000 of interest on deposit, or your interest on money on deposit or bond income tax-free. And you can also have the first £12,300 of capital gains as a UK resident, completely free of tax. In addition to which, you can invest up to £20,000 as a UK resident into what we call an individual savings account. We always recommend that. That's a staple of tax planning because it's instant access and costs. It's very, very cheap, and all of the income and all of the gains generated by whatever you wish to hold is completely free of tax. There are ISA millionaires in the UK who've always done their savings and the money's grown. It's a tremendously important part of planning over the long term. And of course, if there happen to be two of you, these are the total allowances. Now, if we were to contrive everything perfectly, and life is never like that, but if we were to make sure you each used your allowances optimally, you can have up to £55,600 of income and gains without paying a penny of UK tax, which is astounding when you think of the UK as a high tax country. So we want to plan to use those. So the second principle, if you cast your mind right back to the beginning of the talk when I talked about different types of income, dividend income and capital gains are more tax efficient than anything else. So to the extent that we have the control to do so, and you have the flexibility to do so, we would want you to generate dividend income, to use that dividend allowance and and your personal allowance, because dividend income at the basic rate of tax is just 7.5%. Capital gains tax at the basic rate of tax for shares and units and funds is 10%. So we want to ensure that you generate enough dividend income to use a reasonable chunk, the majority of your basic rate threshold, but we want to stop there. We want to leave you some room for subsequent income growth over following years. And of course, then we want to make sure that we optimize the ownership of assets if there are two of you. One of you might have a big pension, the other one might not. We need to ensure that we weight the investment of assets appropriately. That may be sufficient. That may do the job entirely for you. But to the extent that it doesn't, we would then recommend the use of something called an international investment account. So in essence, let me just put everything up here, actually. There we go. I think that's everything. All we're talking about here is a portfolio of units in funds, which are invested and produce returns. You are able, as a UK resident, to draw out of that account up to 5% of the amount you invested per policy year, and you are not taxed in that year on either what you draw out or the actual income and gains generated. In other words, where you might otherwise have been subject to tax at higher rates, we can hold an investment portfolio within an international investment account and allow that to grow without being subject to tax. And if you don't draw 5% per year, that's okay. What you don't draw can be carried forward to the next year. And it's a structure that can be used extremely effectively for inheritance tax planning. Now, to say that this is tax-free is a little bit misleading. It's tax-free on a year-on-year basis, but there are circumstances in which income tax can be due, and I've listed 4 circumstances there. And if you look at that, you'll see that you have control over all of those, but the last one, you don't know when you're going to die, but you do know you can control everything else. But if you are a UK resident when one of these events happens, it's important to know that this type of arrangement carries specific reliefs that have been legislated for in the UK to allow you to be exempt from tax on the gains relating to the non-resident periods. And there are a number of ways in which we can actually bring the charge to tax down on the UK relevant bit to no more than 20%. So it's actually a pretty tax efficient thing to do. And if you are one of these people who's going to go back to the UK but might eventually become non-resident again, well, if you become non-resident, that deferral of tax becomes a full exemption. If you have one of those events that happen as a non-resident, provided certain conditions are met, then it's an exemption. So you're hedging your bets by doing this. We think it's a tremendously good vehicle. So that's a load of information right there. Let me then give you an example to illustrate the power of these tax planning techniques. So Matthew and Gemma, moving back to the UK, they've sold down what they can sell down. They got various lump sums and they've sold a property, and they end up with about £2.5 million to invest. They have other incomes. Both Matthew and Gemma have got some pension income, which is taxable in the UK, and they've got an investment property generating taxable profit of £18,000 a year. They want us to construct, they already own their main home, they want us to construct a portfolio to generate income after tax and fees of £100,000 a year. And like most people moving back to the UK in their type of position, pretty low appetite for investment risk, low to medium risk. In other words, 4 to 5% returns after fees per year. How do we do that? First of all, we put in our pension income and our rental profit. We can't get out of that. We would obviously recommend that both Matthew and Gemma retain some money on deposit, in this case a tiny bit more than 1 year's worth of income. That makes sense. So let's assume that generates a return of 1%. Maybe that's a bit bullish, but just humour me. They are basic rate taxpayers, so the first £1,000 each of that is tax free. Then we'd recommend them having a jointly held equity portfolio, just stocks and shares that they hold directly. In this case, I've illustrated that with £850,000, and I've suggested an income return of 5%. And of course, yes, you can tell I'm not a financial advisor. That probably is a bit high. But again, they each have dividend income, so £2,000 of each of that. Of those sums are tax-free. So there's their income for £47,600. Then we encourage them each to invest £20,000 a year into an ISA. So that would generate tax-free incomes of £600 a year. And what's left, in order to prevent them going into higher rates of tax, is held in an international investment account from which they can, and in this case, choose to draw 5% per year, no tax to pay. So you can see that adds then another 76,000. So they've produced in total £150,000 of income. What's the tax on that? Well, you might be surprised to learn that it's only £4,000. That's an effective rate of 2.7%, because the only thing they're paying tax on is pension, rental and interest after allowances, and dividends on their equity portfolio after the dividend allowances. A very, very low rate of tax. We might then encourage them to continue to make ISA investments. So take £40,000 of that away to reinvest. So that still leaves them above £100,000. But if they needed a bit more than that, what they could do is choose to take gains from their equity portfolios. And let's just say that the gains were 2.5%. In other words, we know that that's basically using their capital gains tax allowances. That's tax-free money. So they've actually got potential net spendable income if they wish to draw on it a somewhat more. An effective rate of tax, as I said, of 2.71%. Mandate was to generate 100,000, risk tolerance of 4 to 5%, effective rate of tax of 2.71%. Now, of course, that's a contrived example, but it's an illustration of how we can use very simple, straightforward, non-contentious examples to generate great returns after fees. Anything else I'd like to say before I hand over to Nigel? There's a whole load of other things that we can talk about. I won't talk about that. That's silly. We can cover that on an individual basis. But suffice to say, there's great opportunities in addition to the ones I've talked about today. Select Investors has a fantastic repatriation service to the UK. Repatriation needn't be a painful thing from a financial and tax perspective if it's managed correctly, and we do that. And Nigel, who you will be hearing from in just a moment, is a key part of that service. We have an award-winning investment management approach. I won't belabor that too much, but that's what we do at St James's Place. We've won over 38 awards in the last 10 years for the quality of our investment management. Often, if you become a client of Select Investors, we will provide tax advice and returns for the life of the investment relationship at no cost, which is very important because then that's all joined up, and we provide a guarantee that the advice we provide is correct. And you can see what I'm saying there. So without further ado, there's a couple more webinars we've got coming up in the next number of weeks. So UK domicile, property markets and mortgages and will writing. I think I'm presenting all of those. Feel free to reach out to us. We'll be delighted, obviously, to have you attend those. So I think it's now time to run our next poll question. So Helen, if you're there, I'd be grateful if you could pop that up there and give our viewers a chance to answer that. What are your main concerns about moving to the UK? Logistics and stress, financial planning, settling in and adjusting, or missing expat life? And we'll just give a few minutes to see the votes on that. A couple of seconds. Excellent. Helen, do we have any votes coming on that? Okay, that's Nigel. Obviously, that's very important in terms of what you're going to be speaking about now. Logistics, financial planning, and high rates of tax. Well, hopefully, we've given you a little bit of hope about that. And missing expat life, very interesting one. So, without further ado, let me now hand over to Nigel. Thanks ever so much once again, Nigel, for joining us. And here is your slide, my friends.
Thank you, Martin, and good afternoon, everybody, or good morning, all, if anybody is joining from the UK. I'm just for a perspective of context. I'm sitting in my executive office, very close to Epsom Downs. Some might call it a man cave, which is obviously where I've come back to settle some 30 months ago from my times in Asia. So it's been great to join you all again. This is my second of these, should we say, talks with the BritCham and indeed Martin and select investors. So there's obviously going to be an element of repetition today, but in setting out trying to bring some meaningful and some valued content to the session, I'm trying to bring a perspective which is based on personal experience, whilst at the same time authentic and sincere. And hopefully that will give you a little bit of an insight into what I have experienced, as many expats do when repatriating, with complicated tax and financial affairs, and indeed life, challenges, as it were, and the journey of what that might look like. No need to panic; it's all relatively straightforward. But I should imagine I'll be more than about 15 minutes this morning or this afternoon, in your case, to take you through that. So. I suppose a good way would be to refer back to the agenda very quickly. So why I left Singapore, because it's the sort of beginning of the journey for anybody, their sort of day of trepidation when they leave Changi Airport and think we'll ever go back again. Well, in fact, I think I've been back 3 times since and would have probably planned to have gone back, a number of times, subject to the dreadful COVID experience we've all been through for the last, 7 or 8 months. But that being said, you do return. But I arrived back in sort of the UK after probably 4.5 years of working in Singapore. So I arrived February 2014 and I departed, arrived in, the UK February, I'll start again. I arrived in Singapore in February 2014 and arrived back in the UK in the middle part of 2018. So definitely not an experienced or seasoned expat. And as people quite often say, Singapore is very much expat life for beginners, but a tremendous experience, which, I wouldn't have changed my life. As Martin and I think David alluded to, I was the former CEO of St James's Place Wealth Management, and my role specifically was to set up the business in the framework and style very similar to that of the model that St James's Place operates in the UK. But that's another story. As I said, we had an opportunity from a family perspective to build our runway, and I'll touch on that a number of times during my chat, which was, it gave us a good opportunity of a 6-month lead-in period, but our time had sort of come through quite bizarrely a decision-making on my part that came from an ill health issue, which is now resolved, and that's why the likes of Martin and he did his business partner Miles at Select Investors were able to drag me off the golf courses, which my golfer still needs quite a lot of work on it. And my wife's quite pleased because it dragged me off the race courses of Surrey as well, and got me back to do a little bit of non-executive work with the guys, as it were. So let me just talk to begin with about a very obvious thing that we probably do in our business lives, but sometimes not particularly good at in our own personal lives, which is the value of some good preparation. And the sort of place where I'd like to begin there is just to explain, I suppose, how you have to adopt a very self-reliant attitude to this when you know that eventual date of repatriating to wherever it might be, in this case, it was the UK for me. What does it involve? But why I sort of talk about the self-reliant aspect is that a lot of the things that you might have become accustomed to, for example, in your role or your experience in terms of your lifestyle, suddenly fall away. So, for example, dare I say, helpers and indeed, companies that you might work with, or things like relocation companies, suddenly disappear the minute you arrive back into the UK. And therefore, the more that you can have control, knowledge, and complete input to your sort of plan, as it were, to return to the UK, the more important that is. Because people that I've known that have delegated it to third parties, and my wife's quite an organised lady, I can assure you, it was good that we worked on this together. And she very much had, the exit part of Singapore down to her. and I had the entry part of the UK down to me, and it worked well. It was a good project, and we'd sit down every week or 10 days and sort of just monitor progress and check that it worked. So I would say definitely have it as a joint plan, and make sure that you do take responsibility and try not to delegate too much of it. There's lots of websites, there's lots of social media sort of commentary about it, but I would say quite simply, with regard to the preparation, just own it, and and regularly just check your progress against some sort of very simple to-do list. When we arrived back in the UK, the important thing was obviously the value of the runway that we'd built, which I will touch on in a moment, with regard to some of the things we'd already put in place. But one thing I would say, the danger or the overvalue of relocation companies is something I say, if you've got one, use one, but be very careful not to be completely dependent on it, because our own experience where we did delegate certain things, it didn't work quite as well where we had control of it ourselves. So moving on to life now in the UK, it's all good, thank you. You might want to sort of read the press, and it's quite interesting, as I work regularly with the guys at Select, how news in the UK can be very different to news and current affairs in obviously Asia. I know you still got quite a US sort of headline dictating everything. That's very much moved on in the UK during the last week, and we're now down to vaccines, which is all very positive news. Jeremy Corbyn being reinstated in the Labour Party in some form or another, and indeed, the impending Brexit situation, which I will touch on in a moment. Brexit has a few days to go. It will obviously be one of the important things that shapes, I should imagine, the UK going forward, even more so than COVID. The good news is that if I read the Telegraph correctly this morning, the Irish are now describing that they've achieved landing zones with regard to the the agreement, and indeed the French are now happy to settle and agree on some of the fishing rights. So I think on reflection, there's a fish and chips joke in there somewhere, but I won't try this early in the morning. Things with regard to Brexit will create a little bit of a change here, there's no doubt of it, and it's another corridor of uncertainty, very similar to COVID, but it's not something for you to really sort of worry about. It doesn't really at this stage dictate in any way on day-to-day life. It will have an impact on certain parts, but I would say if you are returning next year, I don't think it will be half as challenging as the experience that we've had with COVID, as it were. When you get back to the UK, one thing with regard to that sort of 18% return that some of you have just sort of fed back in terms of the survey is that life is very different. A couple of things to get used to is people won't pack your bags for you when grocery shopping. That stops, and a sofa takes typically 10 to 12 weeks to get ordered and delivered, as it were. But tongue in cheek, the speed of things isn't quite the same, and the relationship you have with friends and acquaintances is very different, as I say. So that esprit de corps that you might feel at the moment in times, and that sort of mutuality bit that you have disappears, and people aren't quite as, I suppose, quite as proactive or as keen to sort of be quite as social. I'll be very honest about that. Myself and my wife have found ourselves busy doing lots of other things, including visits to the museums and things like that when they are open. And you will feel that pace is maybe a little bit slower in the UK. There's a lot more to do, but I would say definitely that esprit de corps disappears, as it were, and it's something to think of in terms of energizing your past network of friends. And fortunately, we had 3 or 4 people that we know that we're very close to that have returned about the same time. And in fact, they have become quite an important part of our social life. Friends haven't really changed. They go to the same pubs, support the same football teams, and shop at the same shops. Nothing is really different, but they don't have quite the same attitude that I think that we have developed as a family over the 5 years of us being, in Singapore, as it were. So firstly, important bit of news, which I know will be important to most of you. Wine is incredibly cheaper and a far better, should we say, choice other than just that typical Australian Sauvignon Blanc. So lots of exciting new choices there. And more importantly, you get the seasons. As you can see this morning, it is nice to have a reasonably frosty start to the morning in my man cave. But, we're sort of, as I say, you know, the end of autumn, sort of, or the middle of autumn, touching on winter, and it's a nice bit of sun out there this morning. Wintry wind, but not bad. So there are benefits, and there are things that I think, for all intents and purposes, that, you know, you will definitely benefit from. Significant number of our friends have returned to Singapore, and I base not just my feedback to you guys today on my own experiences, but theirs. And there is a little bit of pioneering all over again. I met some friends just recently who were Singapore, then Geneva, and coming back to just down the road from us, a place called Cranley, which is close to Guildford. You know, they bought a new home, and, you know, the first couple of weeks they were sitting on deck chairs and, would you believe, one or two bits of pieces of furniture that we lent them that were meant to be for my daughters in their flats at some time in the future. So sometimes, you know, things don't work to plan, so always have contingencies. And I think, you know, Andrew and Mairead were very happy for us to have sort of lent a hand there. But their experiences were not dissimilar to our own, as it were. But there is no need for trepidation, you know, and I say, but you just can't be that little bit complacent. I want to touch, not in anything like the deliberate detail that Martin does so very well, about planning for the future in terms of the financial piece. I had a bit of a health shock, as I said, and it made me take a real sort of MOT with regard to my own financial and tax affairs. So I was very prepared in coming back. And obviously, whilst I wouldn't say I was a specialist on the tax side to the same extent that maybe Martin is, but for all intents and purposes, I do know my way around some of the financial affairs. So, you know, when you get back to the UK, tax is something that just completely preoccupies you after the experiences you might have been having in Singapore. It is complicated. It has lots of different facets, and Martin's, you know, I suppose, presentation doesn't do it justice to how many different challenges you have, because immediately you start thinking about how to take income. As I said, I was looking at sort of full-blown retirement, but it's become a bit of semi-retirement. And whilst I'd like to do it for charity, I do bill Martin from time to time for my services, and that generates an income. In addition to that, I have retirement income. In addition to that, I have investment income. And whilst I thought it would be quite easy to do my own self-assessment, Martin kindly introduced me to a really capable accountant called John, who is now doing all that for me. So all of a sudden, the most simplest of things are not. And that's from somebody who I would say, you know, I wouldn't say I was a financial guru, far from it, but I do know my way around. So I couldn't stress more important that part of your exit process is to liaise with somebody like Martin to begin that process, understanding how you might be thinking about living, taking income, retiring or not in the UK. What does your life actually look at? Not where you've got to, but what does the next 6 months, a year look like for you? And very quickly after that, legacy planning is now the latest thing, because I have to try to work out, do I have enough? And if so, how much do I obviously, you know, want to start gifting away, or indeed encourage my daughters to get out of my home, both of whom still live with me. And what I mean by that, you know, not tongue in cheek, is that obviously there are significant taxes on estate planning and inheritance tax, and you have to get very, very focused on terms of what money you should spend firstly, whether it be ISA income versus pension monies, which, by the way, it is ISA income and investment income, and for all intents and purposes, you know, any other facets of income you have. So, you know, retirement planning moves very quickly to legacy planning. To end, I'll give you a couple of hints and tips. I'm rushing a little bit because we are tight on time, but some practical hints and tips that I've learned from experience, and these are things which are put as housekeeping. Most of the arrangements that you like to set up with regard to your new home or where you live can be accessed online. So I would do some research to see if you're going to have a TV provider, or, you know, for all intents and purposes, a broadband provider, or, you know, electricity or gas. Try to do some research that they're available online and they have good platforms, because most of what you will need to do initially will be online. You know, the calls are very hard to get through to. You're a different time of the day, so look for those particular utilities people that, you know, offer the best online service. You can switch them. There's lots of alternative things like television, so try not to commit to anything initially, whether you've got Sky, Virgin, BT, Netflix, Freeview, Apple. you know, whatever it is, just an abundance of media in that particular area. And initially I would say, you know, commit to very short-term contracts, as it were. Make sure you begin a credit rating. I have said this previously. That means if you don't have a UK credit card or a UK, you know, footprint, some of you have been out of the UK for a long time, make sure you start to have some regular commitments that you make on a credit card with a UK bank account, so you can start create your own credit rating, because otherwise you won't have that footprint and it will be hard to mirror across some of the activities that represent your true credit worth from living in Asia, as it were. Register with a GP, because, you know, they do say that you're not really entitled to get back into the system for 6 months. It doesn't work like that, but very, very quickly, you know, make sure you engage with your general practitioner, definitely through, you know, times such as this that are very challenging. Get yourself a UK accountant. Martin can refer to you on that. I'd obviously say that, but it's really important that if you have any significant wealth, you're working alongside the guys, for example, in Select, Miles and Martin, to help that journey, and have a UK accountant that will help you, you know, cross the T's and dot the I's. I really thought I wouldn't need one, but I do. And hopefully that, you know, sort of gives you an indication of just how complicated it is. Revisit your wills immediately. You know, you might not have revisited your wills for a while, but obviously it's worthwhile making sure that they're UK based immediately, and it's a good time to once again have a little bit of an overview of where you think you might want, you know, your estate to be going, you know, right hands, right money, right time principles, it were. Do an air miles audit. You'll have lots of hotels, I should imagine, and airlines you've used whilst being in Singapore. Try to get them all into one card. You know, I made a big mistake of not doing that, and I'm regularly getting angry that Chris Fly is running out here, or AirAsia is running out there, and all it will get me is about a toothbrush or a cup of coffee at the next sort of departure lounge. So make sure that you just bring together all those sorts of clubs and benefits, which I know are very prevalent in Singapore. And the final thing about, I suppose, coming back is try to avoid making significant purchases. And what do I mean by that? Is that we were reasonably sensible when we came back, and we had some money to do in terms of refurbishing of the home. We'd had somebody living here. But I mean things like cars, for example. You might get very excited to see the latest version of the new electric Mini, as my wife has just recently taken delivery of. But we have now been back 2.5 years. So initially we were running around in what might be regarded as old bangers and maybe not the cars that we wanted. But I'm glad I did that, because it does give you a better understanding of not being impetuous, suddenly spending 25,000, 30,000 pounds sterling on, you know, a nice car that you feel for all intents and purposes isn't actually, you know, right for your new lifestyle. And it's just an example of watch the larger purchases, because, you know, there's a lot of people that have said to me, that I've spoken to, I wish I hadn't done this, I hadn't bought that. In summary, it isn't quite as bad as people would like to make out. There is an element of trepidation you should have. Make sure you build that runway. Plan to think about what life might look like when you get to the UK. You know, what is your lifestyle going to be? And obviously, you know, it goes without saying, and you wouldn't expect me to miss the opportunity, we have our own sort of repatriation service. I sort of act as a sort of a guidance or a concierge, as Martin sometimes refers to me as. We're here to guide you on any of the sort of, you know, the bigger issues, but also some of the smaller details. I hope in that very quick whistle-stop short story, it's given you an insight. Helen, hopefully, David, I can pass back to you guys now.
Thank you so much indeed, Nigel, and to Martin. A lot of content there, and conscious that we're sort of running over time, but we've got a couple of questions that have come in. So, Martin, one for you. Can a loss in a private company be carried back to the UK?
Great question. If it is a non-UK company and there's a loss sat in that company as a consequence of trading, or then that really can't be used in the UK. Not unless you've got a UK company as part of the same group. But certainly, you know, if you're looking at realising realising a loss on the sale of shares in that company, well, yeah, you'd want to wait until you've gone back to the UK before doing so. But if you're looking at losses inside a non-UK company, very, very little you can do, I'm afraid.
Great stuff. And if you don't mind us asking, if you are an existing St James's Place client, approximately how much does it cost to get a returning to the UK tax review from yourself, Martin?
Yeah. First of all, that's a lovely question, by the way. So first of all, we sit down and meet with anyone at no cost to really just diagnose and work out what is the advice that we need to provide based on the assessment of their personal situation. Then what we would do is provide a quote based on the amount of time we think it would take, and obviously complexity varies, but the hourly rate is $475 plus GST. It's unusual for me to end up billing more than 8 to 10 hours worth. If, as a consequence of the advice that we give you, you do decide to become an investment client of Select Investors, then as a gesture of goodwill, subsequently, we will waive that fee.
Great stuff. And I'll just allow the audience just a couple of minutes just to ask them any final questions that they may have. So if I may just sort of close, if there aren't any questions from the audience, with a couple of questions, well, a question for Martin and a question for Nigel as well. So Martin, whilst we've got you on screen, if I had to put a gun to your head and told you to come up with the single most important piece of tax planning advice concerning a move to the UK, what would that bit of advice be?
Well, I hope you don't put a gun to my head, David. But yeah, if you did, I think, in all honesty, and I am going to say this, aren't I, planning ahead, making sure you've got a handle on split year treatment, getting that window of tax planning opportunity defined is the most important thing. When we know what that is, we've got time to do the planning. So, you know, getting the advice at least in the tax year ahead of the move, I would say.
And I promise no gun. Nigel, you talked a bit about the runway and building a runway for your return back to the UK as well. What is the one sound piece of advice you would like to share with everyone today in terms of returning back to the UK, given you've been on that journey?
You know, I think the initial meeting that you have with the financial stroke tax advice is really critical to get that in as soon as possible. You know, working with the guys as close as I know, we can just do a better job. You know, time is the real, you know, devil, as it were. And the other bit that I would add to that is, you know, make sure you do some good, you know, I'm ex-military. In fact, it was 40 years ago tomorrow that I joined the military, but that was another life. But we used to have an expression that time is never lost on good reconnaissance. So, you know, what I mean by that is if you can get back to the UK and do some reconnaissance in terms of, you know, where you're going to live, what sort of lifestyle you want. They might be, you know, expensive flights, but they, you know, really be sure where you want to, you know, should we say, lay your new roots, as it were.
Thank you so much. I don't think there's any more questions from the audience. So that leads me to say a huge thank you, Martin and Nigel, for your time. A really great sharing session. And I think, you know, the fact that we have run over a little bit just shows how valuable that hour and a bit has been. So thank you so much indeed.
Thank you very much indeed.
Pleasure, David.
Thank you. That leads me just to say the Chamber has some fantastic webinars coming up. Just to name a few, we've got a discussion on the UK-Singapore relations with the British High Commissioner of Singapore, Cara Owen, on the 24th of November. We've also got our BritCham Christmas party on the 3rd of December. Please do have a look at the website. It's going to be a really, really good event. And although a lot of us can't travel home for Christmas and be with our families, we are very keen to make sure we do keep that community spirit together and have some festive cheer. So please do have a look at the events on the website. You will receive a feedback form from today's session, so please do fill that in. It really helps the Chamber to understand what you would like to hear more of and how today's session went, so we can improve events going for you in the future. And that leaves me to say a very fond farewell, and thank you very much for joining us on this session again. And once again, thank you to Martin and Nigel for their sharing, and to Select Investors for helping to put on this event today. It's very much appreciated. Take care, and I hope to see you soon.